Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about TD SYNNEX Corporation Annual Report. TD SYNNEX Corporation offers a wide range of businesses and services that cater to the information technology (IT) ecosystem. The company's portfolio includes endpoint solutions such as personal computing devices, peripherals, mobile phones, printers, and supplies. It also provides advanced solutions like data center technologies, including hybrid cloud, security, storage, networking, servers, software, and converged infrastructure. In addition to these services, TD SYNNEX Corporation offers design, integration, test, and production value-added solutions, such as thermal testing, power draw efficiency testing, burn-in, quality, and logistics support. The company also provides logistics services, depot repair, customer management services, and cloud services like public cloud solutions, infrastructure as a service, platform as a service, software as a service, security, mobility, AI, and hybrid solutions. Furthermore, TD SYNNEX Corporation offers online services, financing options, including net terms, third-party leasing, floor plan financing, letters of credit-backed financing, and arrangements. The company also provides device-as-a-service to end users and marketing services like direct mail, external media advertising, reseller product training, targeted telemarketing campaigns, national and regional trade shows, trade groups, database analysis, print-on-demand services, and web-based marketing. TD SYNNEX Corporation serves various clients, including value-added resellers, corporate resellers, government resellers, system integrators, direct marketers, retailers, and managed service providers. With a history dating back to 1980, the company has established itself as a leading distributor and solutions aggregator in the IT ecosystem. The stock price of TD SYNNEX Corp. (SNX) has experienced a slight increase over the past year, driven by several key news events and financial achievements. One notable event was the company's record Q4 and fiscal 2025 financial results, which exceeded expectations and led to a 0.66% rise in per-market trading. The strong performance was attributed to a 15% year-over-year increase in non-GAAP gross billings and a 24% increase in non-GAAP diluted earnings per share. TD SYNNEX's focus on AI-driven growth has also contributed to the stock price increase. The company launched its AI Game Plan initiative, which aims to assist partners in accelerating AI adoption and capitalizing on the AI-driven hardware refresh cycle. Analysts have noted that TD SYNNEX is well-positioned to benefit from increased AI spending and memory cost inflation due to its distribution model. In addition to these financial achievements, TD SYNNEX has received recognition for its strong operational execution and trusted relationships within the industry. The company was named one of Fortune's 2026 World's Most Admired Companies for the fifth consecutive year, highlighting its commitment to excellence. The stock price increase is also attributed to strategic partnerships, such as the recent partnership with Dialpad to bring agentic AI communications to global markets. Furthermore, positive analyst ratings from Morgan Stanley have contributed to the upward trend, with some analysts projecting a price target of up to $200, suggesting significant upside potential for the stock. Overall, the combination of strong financial performance, focus on AI-driven growth, recognition as one of Fortune's World's Most Admired Companies, strategic partnerships, and positive analyst ratings have contributed to the slight increase in TD SYNNEX Corp's stock price over the past year. TD SYNNEX Corporation market capitalization of $13 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that TD SYNNEX Corporation holds a significant advantage in their industry. TD SYNNEX Corporation trades at a lower price-to-earnings ratio of 16 times and a higher price-to-book ratio of 1.5 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The leverage on the balance sheet appears elevated, with liabilities of 73% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be categorized into several key areas. On the growth side, end market demand for IT products is a significant driver, as well as partners' strategic initiatives and business models. The introduction of new IT products and software by OEM suppliers also contributes to revenue growth. Additionally, trends towards cloud computing, overall economic growth, and acquisitions all play a role in driving revenue upwards. On the decline side, variability in demand by customers is a major driver, along with loss or deterioration of relationships with major OEM suppliers. Changes in terms and conditions provided by OEM suppliers, significant changes in supplier finance programs, and low gross margins due to price competition are also contributing factors. Furthermore, decrease in purchase discounts and rebates from OEM suppliers, inventory value decline, supply shortages or delays, customer concentration, and intense competition in the IT products industry all contribute to revenue decline. Other drivers that can impact revenue growth or decline include credit exposure to customers, changes in financial or economic conditions, failure of IT and telecommunications systems, and disruptions or security breaches on the Internet. These factors can have a significant impact on revenue, making it essential for companies to stay vigilant and adapt to changing market conditions. The net income of a company underwent significant changes between 2024 and 2025. Initially, it decreased due to various reasons such as variability in demand, loss of major OEM supplier relationships, increased competition, and foreign currency exchange rate fluctuations. However, the net income increased by $52.65 million, 29.8% increase, due to decreased hedging costs, higher income during the period, and a higher effective tax rate. The profit margins also experienced changes during this period. They decreased due to factors such as increased competition, price pressures, loss of significant customers, inventory write-downs, supply shortages or delays from OEM suppliers, and disruptions to China-based operations. However, there were some regions where the profit margins increased, including Europe, where it rose from 1.34% to 1.38%. Overall, despite the fluctuations in net income and profit margins, the company's net income increased by 20% from 2024 to 2025. The changes in these financial metrics can be attributed to various factors such as changes in demand, competition, supplier relationships, and foreign currency exchange rates. The company's financial performance is a testament to its ability to generate positive operating cash flow. According to the provided data, in 2025, the net cash provided by operating activities was a substantial $1.5 billion, indicating a significant increase from the previous year. This trend of increasing operating cash flow is further reinforced by the total operating cash flow figure for the company, which stands at an impressive $14,142,970. This not only underscores the company's financial stability, but also its ability to generate sufficient funds to meet its operational needs. The fact that the company has been able to consistently generate positive operating cash flow over the past 2 years is a clear indication of its financial health and resilience. This achievement is a result of the company's efficient management practices, effective cost control measures, and strategic investments in key areas. The company's debt level and interest expenses have undergone significant changes over the past year. According to the extracted summaries, the total debt has increased from $3.9 billion in 2024 to $4.6 billion in 2025, representing an 18% increase. This trend is consistent across multiple pages, including page 46 and page 57. In terms of interest expenses, there is a clear indication that they have increased significantly. The data on page 41 shows an 11.6% rise from $319,458,000 to $356,608,000 in 2025 compared to 2024. This increase is also reflected on other pages, including page 58 and page 95. The overall picture suggests that the company's debt level has increased substantially, while interest expenses have also risen by a significant margin. Management is emphasizing the importance of adapting to the rapidly changing technology landscape. The company's industry is undergoing a digital transformation, with a shift towards cloud computing, and management believes it's essential to provide a comprehensive portfolio that spans the entire computing continuum. To stay ahead in this competitive market, management is prioritizing innovation and operational excellence through total rewards programs and investing in employee development. This includes equipping coworkers with skills, tools, and mindsets necessary for the evolving workplace. In terms of strategy, the company is pursuing strategic acquisitions and investments to expand its business into new markets. However, management acknowledges that these moves may result in dilutive issuances of equity securities and potential losses. Management is also focused on managing inventory with precision to avoid write-downs and ensure timely customer order fulfillment. Additionally, they are taking steps to mitigate the impact of foreign currency exchange rate changes through hedging strategies. Overall, management's outlook for the company is one of growth and expansion, driven by innovation, operational excellence, and strategic investments. The company has made several significant acquisitions and divestitures in recent years. In terms of acquisitions, the company acquired Aptium Technologies, LLC, and its subsidiaries for $105.1 million on July 1, 2025. Additionally, Tech Data Corporation was acquired through a series of mergers on September 1, 2021. Furthermore, the company has also sold accounts receivable to financial institutions worth $1.8 billion as of November 30, 2025. On the other hand, the company has also made divestitures, although specific details are limited to dispositions mentioned in page 12. The company has demonstrated its commitment to returning value to shareholders through both dividend payments and share buybacks. In terms of dividends, the company has paid quarterly cash dividends in 2025 and 2024, with $0.44 per share declared for each quarter. The total dividend payment for 2025 was $1.76 per share, indicating a consistent payout policy. This suggests that the company is committed to rewarding its shareholders through regular dividend payments. In addition to dividend payments, the company has also engaged in share buybacks. In fiscal year 2025, the company repurchased 4,448,000 shares under the share repurchase program at an average price of $134.03 per share. This indicates that the company is actively managing its capital structure and returning value to shareholders through strategic share purchases. Overall, the company's dividend payments and share buybacks demonstrate a clear commitment to shareholder value creation and return on investment. There are concerns about inventory buildup and supply chain disruption that warrant attention. Inventory buildup is a risk due to various factors such as suppliers' price reductions or technological changes, which can lead to obsolescence and decline in inventory value. Additionally, excess inventory can result from anticipated demand not materializing, further affecting gross margin. Supply chain disruptions are also a concern, with potential shortages or delays in receiving products from OEM suppliers. This can be due to various factors such as supply chain constraints, failures of IT or telecommunication systems, or disruptions in local or international supply chains. Furthermore, consolidation of OEM suppliers can lead to reduced authorized distributors and increased competition. The impact of these concerns is not limited to the company's operations, but also has broader implications for the global economy. A widespread outbreak of an illness or public health crisis can disrupt global supply chains, leading to extended periods of economic disruption and affecting businesses worldwide. That concludes the financial summary for TD SYNNEX Corporation. Feel free to comment below, and I will be happy to answer them when possible.